Rahul Chadha joins us. Let's take a conversation forward. Rahul, fantastic to have you back. Thank you for joining us. Rahul, the Bulls are back, but are they here to stay?
Nikunj, I think next 3-4 months would be challenging, and I think we saw that in IT services result where there is a sharp demand slowdown which has happened in recent months, and I think it continues. U.S. economy is slowing further, and likely that probably around fourth quarter of this year or first quarter of next year goes into a mild shallow recession. So I think that is where the slowdown is going to come in the Indian economy also. That's largely going to come from weakness in exports, and that impacts the job creation around it.
What should be the best investment strategy? There is a visible fear in IT, but there is a visible growth in banking. There is a visible slowdown in rural India, but there is a visible uptick in urban India. What is the best way to stay put in this market?
I think the best way to stay put is take a medium term view. Look, near term is going to be challenging, but that is where you get entry points. Most of us been saying that for a while, but look, in markets you don't make money every day, every month. You make money in spurts, and this is what we've got to understand. But if you're not positioned for it, you miss those spurts. And I think somewhere those moments are going to come either in the fourth quarter of this year or the first quarter of next year when Fed worried about slowing growth and inflation becoming less of an issue, starts cutting rates. And that's where things would improve. And I think the rally here is going to be led by domestic cyclical. So we've seen strong set of numbers come over the weekend by the likes of ICICI Bank. Reliance has also done a good job. I think these are the names which would take the market to the next level.
Rahul, when we spoke to you last, you were about 30% of your exposure was in banks and financials. Now that investment has worked. But now are we reaching at that pivot point where financials will slow down, the base effect will kick in, deposit growth is slow, economy is slowing down. So one side, there is merit in recognizing that financials are core to everyone's portfolio, but are best of the gains behind us?
Definitely. Fourth quarter last year, which was 22, first quarter of 23, is going to be best for financials. NI growth is going to slow down from here. You would see these banks build up more contingencies also because some of the delinquencies are going to pick up. But look, life's relative. Such is going to be the slowdown in other sectors. But our view is, unlike the previous cycles where a lot of excess investment was done and it took a while to come out of that down cycle, we've not seen India or US done much of those excessive investments. It's largely in China where they've done the over investment, which is where growth is going to slow down. And I think that's where even if a down cycle comes, which is going to come in coming quarters, it's not going to be that harsh.
Rahul, are you surprised with the kind of IT reportage we've seen, the commentary from TCS as well as Infosys, or do you think that was well anticipated?
Yeah, but to be fair, our sense was still Feb. These guys sounded very bullish about the demand outlook. What happened was we had this mini banking crisis in US, the SVB crisis, and post that, some of these discretionary projects were put on hold, and that's why once these companies came and declared the results at the end of Q1, those were disappointing because one was not expecting such soft numbers so early in the cycle, basically.
Rahul, one pocket in India where you're not seeing any kind of slowdown is in the luxury market, be it high-end real estate, be it watches, jewelry, clothing, what have you. Cars as well, right? I mean, that of course is on a low base, but yes, cars as well as selling a lot more, especially when it comes to the, super segment. But tell me, what is that telling you about the underlying strength of the haves in India?
I think it's the same trend everywhere. You look at the performance of Louis Vuitton for last 6 months, it's one of the top performing names. It's done much better than the Chinese consumption names because look, it's super rich, who've done well. And this is something we've seen post COVID, basically, the K-shaped recovery, as we say. The haves, as you call it, who have much resilient balance sheet, who've got much stronger incomes, who can weather the inflation better. And these guys have kept on with the consumption. In fact, post-COVID, they've come out and spent more. So that part of the market has been fairly resilient. Unfortunately, in India, we've got few plays. Probably you can say something like a Titan would be good plays on that. Something like hotels would be an indirect play on that, but there are not many plays. on this space, basically, or this segment.
Hi, morning. I wanted to get in your take as well on the healthcare or the pharma sector. Do you believe that a re-rating is on the cards?
We've liked hospitals over generic pharma and continue to do so. Again, it's been hard to make money honestly in generic pharma. There have been few names here and there who made money, but we continue to believe in this hospital story. What we see is a huge penetration story which is there. We yet to see the benefits of medical tourism. We've seen that only for a quarter or two. That builds on that. So for us, hospitals would be a better way, lot more kind of a steady, predictable way to play this healthcare story.
I mean, these are businesses which are constantly hungry for capex. The return ratios are nowhere close to even 20%. So I can say that India needs healthcare, but that anybody would have said 20 years ago also, and that everybody will say 20 years after also.
So, Nikhil, what's happened is, and what's led to the re-rating of the sector is that government's not invested with pricing of most of the surgeries or services, etc. It happened about 5-6 years back, but these companies stopped the investment, and government realized post-COVID that you need these companies to do. I think the maths here is, if you look at the average revenue per beds, those are somewhere around 70-75,000. The ROCs are twice that of what you see in our hotel space, etc. And typically, you buy these names when they've done bulk of the capex. Most of these hospitals are doing brownfield capex. None of them are doing large greenfield capex, and which is why what you said was relevant for a new hospital, but not for somebody who's adding 10% beds to his existing capacity.
So as we look into the future, Rahul, let's say 2023 and beyond, how much weightage would you pay to the fact that there is a general election cycle same time next year? Do you think 6 months before that markets will be into a state of limbo, because historically we've seen a decision-making freeze 3, 4, 5 months ahead of the election?
So I think markets somewhere discounting that, which is why they move up, but they're not really touching those highs which we all thought they would this year, with the economy being in such strong shape. We've got state elections, and there are talks that some of the state elections may not go the ruling party's way. So I think there is going to be a skepticism on what happens in the general elections. So I think this is the period where market will start getting slightly worried about the outcome for May 24 elections. So I think those risks, those uncertainties would be somewhere baked in the valuations here.
Okay, that's the view coming in, but let's get in a sense as to what the outlook is as well when it comes to the entire energy basket. For instance, you have something like Reliance Industries that came out with their numbers, and we've seen the fluctuation as well in crude oil prices across the board. What's the outlook on energy as a space, given that it clearly is very news flow dominated?
Okay, so here we are talking of two things. One is crude oil prices. So clearly oil between whatever 75 to 90 is good for India. And what one hears is, at the margin, though OPEC's cut supplies, but there are additional supplies coming from Russia, which are not being adequately documented for which is where the world's kind of stocked with oil. The Chinese have stocked a lot of oil, so which is to India's advantage, that oil today is not at 125 but $85-$90. And then when we look at stocks, look, clearly Reliance is promising, but what market fancies much more than the oils and the chemical story is the retail story, the telecom story. Things got a bit slow recently, but I think there's a longer term potential over there, and a very strong longer term potential. And in the coming years, as you see IPO of some of these companies, there's going to be even more excitement about the name.
Rahul, just an extension to the point that we were earlier talking about, the luxury theme. What's happening in the property market or the real estate segment as well is quite remarkable. We were just talking about as to how macrotech developers, or known as Lodha here, has upped its guidance significantly, beating all and every estimates. And the Q4 updates coming in from the other regional players as well is as strong.
Absolutely. I mean, we saw the sales DLF did in Gurgaon, and it was phenomenal what they did in terms of the property which was sold. And if I'm not mistaken, the average ticket size there was about 7 crores. So this is what happens when kind of the pent up demand wakes up basically. So for 8 years, nothing happened in the real estate market in India, whereas elsewhere in the world, there was a big real estate boom between, let's say, 2015 to 2022, etc. And now it's reversing. That post-COVID, people realize they need bigger homes and property prices are moving up, which is what forcing people to act. So some of these names are promising. Post-COVID, we were a bit early in the names and we built a sizable exposure in the real estate names. Though recently, or last 6-9 months, we pruned the position because RBI was hiking rates. But look, this is a good time to add these names from a 2-3 year perspective.
Do you see your top three positions changing in next 1 year, or you think you'll ride them?
I think highly likely. See, there's a bit of a defensive part of our portfolio. We've got consumer staples. We've got the likes of Power Grid in our portfolio. I think over 6-9 months, you will see higher weights for consumer discretionary. They're still part of our portfolio, but one would like to increase weights to them as one gets confidence that we've gone through this economic downturn and things improve significantly, or growth outlook would improve significantly in 24 and onwards.
Rahul, as per 31st January, though, your top three positions, your second one was actually in forces. I don't know whether that still stands or not. Please correct me if I'm wrong.
Yeah. So I think because of the stock price, it won't be top two, but probably still in top five. We've not done much with the name. IT services would be still about 9 to 10% of our portfolio. Look, we believe in this long-term growth prospects. These are great companies, good free cash flow yields. And what we've seen is businesses globally realize post-COVID that digitization, hyper-personalization is imperative for staying relevant for the coming decades, and the spends are going to happen. Though what one is doing all the more now is figuring out what does these versions of your chat GPTs or the AIs, the developments which have happened means for the sector. It obviously leashes on a boom of productivity, but does it somewhere cannibalize on the revenues? That is to be seen in coming years.
All right, Rahul, appreciate your time and good to have you on ET now.